Hello everyone and welcome to Finance to JCL. Great to have you here today. It's been a bit of a gap since the last video. I've fortunately managed to catch COVID. I'm recovering okay now. So yeah, back in the groove, and let's have a look at Tesco today. So I'm going to try and work out whether Tesco's a buy or not. But to start with, look at YouGov here, which is a survey site. They do a lot of market research, and Tesco has been heard of, they estimate, by everyone. Essentially 100% of people in the UK have heard of Tesco. And of those, 3/4 have a positive view and a very small number have a negative opinion. So Tesco is well thought of and couldn't be better known. And the other thing with Tesco is they have a consistent 25% share of the kind of grocery market. So 1 in 4 of the market is through Tesco. So I think it's very clear to see that this is a company that everyone is aware of. So Tesco isn't in my portfolio. I'm not a financial advisor, so don't take this as investment recommendations, just my opinions. And what I'd like to do now then is go into a little bit more detail on whether I think Tesco could be a buy or not. And thanks to one of my viewers here who, about a month ago, flagged Tesco as a company that could be worth buying. So I thought, let's have a look at it. And again, please do comment below if you've got any suggestions of things that you'd either like to see reviewed or you think would be good for my portfolio. Okay, so let's try and work out whether Tesco could be a buy. The first thing is, let's have a look at the chance of failure. And we can see here there's been a substantial improvement in the debt to equity position compared to 5 years ago. And there is substantially more equity than there is debt, although that debt figure is still £7 billion, pretty high. And if you look at the balance sheet here, you can see that they have a lot of physical and long-term assets, which more than cover the debt. Now, the cash in itself doesn't cover the debt. So there is that to note, that according to this information, the interest payments are well covered by their EBIT. There's good coverage there. So looks like it's not too much of an issue in terms of paying the debt that they have. And then in terms of, if you're thinking about is it likely to fail, it's got that 1 in 4 market share, very consistent. Everyone knows about them. And yeah, I think it's grocery retail. It's very stable and very predictable performance in the main. So I would say that the chance of Tesco going under is pretty low. Okay, so that's the first thing. The next thing is, what about the premise of the business is clear. We know these kind of very stable, predictable businesses aren't very exciting, but they can be when underpriced a good addition to a portfolio. We have try and have a look at what are the signs. So we've got some signs around the insiders, quite a lot of buying, no selling in the last 12 months. So that's good news. I'm not talking massive transactions, but overall, you don't have much in terms of insider ownership, and that's not surprising with this kind of 100-year-old, very large company. Their market cap £17 billion, so it's a decent size. Now, if we have a look at the long-term history, there are some one-off results for 2021 that kind of look a little bit odd. You can see that the revenue is a little dip there. There was some accounting issues many years ago, if I recall. I think they've got over that now. So the operating income since 2015 has been improving nicely. We're up to 2.5 billion. But for some reason, 2021 there's this very unusual net income that's much higher than the operating income. So I perhaps wouldn't look too much at that. It looks like it's some kind of one-off result that's impacting the numbers. I'd rather look at that operating income. And now the other thing to have a look at here is we've got a view from Simply Wall Street of them being 50% undervalued. They think they're £4.45. We'll keep that in the back pocket. Now, the thing with that, of course, is the discount rate is only 5.9%, and I'd be looking at 10%. So I'd expect my number of their value to be probably lower than £4.45 as a ballpark. Price to earnings ratio 23.5. So that it's quite high actually, and there's no kind of value there on the price to book in terms of being undervalued in net assets. So we can have a look at the free cash flow, which is the purple line. We can see that that is due to be at the next forecast 1.7 billion. That's due from 7 analysts, so that's then edging up as you go along. If we perhaps were to also look at the earnings per share, which according to this here is, let's call that 10p, it's about 9.4, but round it, so it's about 10p, and then 2024, you're looking at 20p. So earnings per share doubling in around about 3 years. So if the PE ratio is 23, you're looking then presumably at a PE ratio of half that, so around about 11 or 12 as a forward PE. So that becomes quite interesting. It's quite cheap on that basis. It's a nice future return on equity there of around about 10%, which for this kind of business is quite reasonable. And the dividend here is over 4%, which again is quite an interesting asset. The payout ratio this period seems overly high, but going forward, it's only at 50-odd%, so it looks a bit more sustainable. I think what I would do here is I've done a bit of a calculation. I've used that 1,700 to 1.7 billion as the free cash flow. And if we said it's going to grow at 5%, which is quite a conservative view, 10 years, discounting at 10%, 2% perpetuity growth, number of shares outstanding is 7.7 billion. I've got that from the Yahoo information here. And it's trading at 222. Have a look at the chart. Last thing to have a look at, you can see here £2.22. And do note here that earlier this year there was a stock split, which is why you've got this bit of a drop off here. My calculation's coming out at £3.40. If you want 10% here, currently £2.22. So it looks like to me there's a 50% upside on capital. It's an interesting. I mean, it's not one you're gonna make a massive amount of money on. If you've got quite a lot of cash in the portfolio, and perhaps you're looking for a way to deploy it in a reasonably safe way, Tesco looks like a decent option because there is some upside in terms of a 10% a year return to discount rate, and there's over a 4% dividend, and it looks quite sustainable in the longer run. So that's my thought on Tesco. Now, if you want to buy Tesco, if you are UK based, first of all, I've got a link to free trade below. And if you're new to them, you top up the account, use my referral link, we both get a free share. I think it's potentially up to the value of £200, so that's pretty interesting. And then there's interactive brokers there as well if you're an international viewer. So it is Tesco in your portfolio. I'd be very interested here. It's not in mine. And now I'm not going to buy it, I think, on the basis that actually my cash position is quite low at the moment. I've probably got a few too many holdings. I don't want to add more into the mix. But certainly if I had, let's say, cash of 15 or 20%, I would not be averse to putting several percentage points of the portfolio into Tesco as a way to collect that dividend. So there you have it, guys. Thanks for joining me today, and I look forward to catch you on the next one.